Hey there, everyone. Ryan Schul, Street Data Science. Thanks for tuning in today, and I appreciate your time. So, in this analysis, I want to look at how to evaluate the impact of an economic downturn and how that can have an effect on banking operations. So, I worked for a lot of banks over the course of my career. We're going into a period now where there could be a lot of tariffs imposed. Um, in the United States and other countries too, and we're going through kind of like a tariff battle or a tariff war or whatever you want to call it. So there could be a huge economic downturn. I sold all my stocks. I'm 100% in cash right now because I'm kind of afraid of what kind of tidal wave or what kind of tsunami could come. And it changes every day, right? So there's a lot of uncertainty. The market hates uncertainty. It loves precision, predictability, sustainability, but we have none of that right now, right? So if the economy, trends down or, like crashes or whatever, you saw that several times. COVID was the most recent. You saw that in the 2008 financial crisis, 2001, dot-com boom and bust, right? We've seen this multiple times, and those are only some of the more recent ones. You've seen lots of downturns in the economy. So how can that impact the operations of a bank? And I just picked this topic because I work for several banks, and I'm pretty intimate and pretty familiar with that, right? So I know this scenario. So imagine if there was some kind of downturn, uh, again, 2008, 2001, more recently 2020, COVID, right? And this thing hits you, out of the left field, and you don't know what's going on. And there's a sharp recession. Like, how is this going to impact banking operations, right? So we're going to look at a couple different things: scenario analysis and Monte Carlo's analysis and things like that. Monte Carlo simulation, things like that. So I came up with a simple data set right here that I just created by myself dynamically. So I've worked for multiple different banks. I'm not going to name any names, but it's very hard to get access to this data. I certainly don't have access to proprietary data for any bank, right? Because I don't work for the bank. I'm not going to publicly disclose that right here, in the um, in the public domain. I'm not going to do that. So I'm just going to create like a very basic hypothetical scenario that I think we can identify with, and it can resonate with people, right? And getting access to this data can be hard. Like, I've worked for institutions where just getting access to data sometimes is impossible. I worked years ago with a guy named Tom. Tom came onto the team. He couldn't get access to the data. And this is a whole nother story. He was there for 4 months or whatever, couldn't get access. Nothing got turned on for him. His boss came up to him one day and said, "Hey, you're not very productive. You're not doing anything. We're letting you go. Okay, Tom, you're gone. I'm sorry, but we have to let you go because you haven't done anything." He's like, "Well, I had no access to the data. I put in 100 requests for access to the data. They wouldn't give me a username. They didn't give me a password. That's a whole other thing." Let's just create like a realistic scenario with some very simple data that we have access to, okay? Because I know I've been down this path. It's painful to get access to databases, right? You have to get on your hands and knees and beg people, all right? But let's not go through that whole thing right now. Let's just do it straightforward, okay? So we have loan book, deposit, interest income, interest expense, net interest income, and then baseline profit, okay? So what is the profit after we do all of our operations, okay? So let's look at a stress scenario, okay? So I put together all this code, and I'm gonna share all this code with you. I'm gonna put this on the video, or I'm gonna put this into an HTML file. You can download this when you watch the video, and you can follow the steps just to see how the whole data science works, how the whole analysis works, how all the quantitative processes work. You can see this, right? So we have the loan book, deposit, integrated, interest income, interest expense, net interest income, baseline profit. Then we have loan losses, right? That's what we're calculating, loan losses, and the stress profit, okay? So as we start to stress this portfolio, what kind of impact does it have? If the economy tanks, what kind of effect is that going to have on our bank? What kind of impact, right? What can we hypothetically like summarize, or like hypothetically test, right? We want to do a test scenario and see like what kind of impact that can have on our bank, right? Because it's very important to the operations of the institution. So we have that, and this Python script simulates financial operations of a bank to evaluate the impact of increasing, potentially, but probably decreasing profits and increasing loan defaults, right? As you saw this in 2008, it played out very horrifically, I would say very horrifically. I've had very close friends that lost their place when housing prices dropped so much, they just walked away from the property. It's like not worth me paying the mortgage on this thing. If I bought this at like 500K and now it's worth 200K, I don't want to be here anymore. I don't want to be in this scenario. I want to be paying a mortgage. Now, eventually, those all went back up. Like, it's a long term game, right? It's a long term game. But if you buy it at 500K, goes down to 200, that's temporary. You have to sit it and wait it out. But a lot of banks don't want to do it, and sometimes people don't want to do it, right? But in a few years, it can come back, and you can reach equilibrium. If people don't want to do it, they'll just walk away from the thing and say, okay, I'll declare bankruptcy, and that affects the bank too because they're not getting payments on these mortgages. But honestly, it doesn't make a lot of sense to me because you can sell the property, you still have the fixed asset, you have uh, like a quantifiable interest in that asset. You can take ownership and sell that thing. So I don't know why people got all up in arms over the 2008 financial crisis. It doesn't make a whole lot of sense to me, but okay, it is what it is. Everybody is short term, short, like, I don't know what's going on today or tomorrow. You have to look at the long term and be stable and sustainable. That's what you have to do and ride it out, right? Like a lot of people just can't do this. So let's look at a scenario analysis right now. So control enter. So a scenario analysis basically will say, okay, what if this happens? What if that happens? Like, give me a couple different outcomes. And it's very specific and very well defined. So we have a couple different scenarios here: mild recession, moderate recession, and severe recession, and then the loan losses, okay, and the market loss, and then the total loss, okay. So in this kind of situation, we've defined the stress scenarios. We've defined the simulation, right? So each scenario includes like default rates, assumed portfolio exposure, how much of your portfolio, how much of your investments are exposed to a downturn, right? If there's a negative impact on stock market or the economy or something like that, how does that play out in your business? It's very complicated. It's very dynamic, and there can be a lot of implications, right? What kind of scenario loss calculations do you have to sustain? I've done other videos on this. Probability of default, loss given default, exposure at default. Like, what happens? How does this all play out? It's pretty complicated, but it's not that complicated. We can still quantify it. We can still understand it. And then we have a scenario summary table. That's what I just showed you right here. Okay. So we have the scenario, loss market, the loan loss, sorry, the market loss, and then the total loss under different outcomes. So this is mild, this is moderate, and this is a severe recession. And then how does this look visually, right? I always say a picture is worth 1,000 words. If we have a mild recession, we have about $13.5 million loss. Moderate recession, which is pretty big, not huge, $40 million loss, and a severe recession, $100 million loss um, on this book of business for the bank, right? Let's go $100 million loss. That's a big loss. Okay, that 100 million, if you lose that, that's pretty substantial. That's pretty substantial. People are going to take notice of that, and they are going to understand that. So that's a simulation analysis. Let's go into a Monte Carlo simulation. And this is where we run lots and lots and lots of iterations and try to understand every potential possible outcome, right? So in scenario analysis, basically you have a few well-defined quantified scenarios. In this case, we just have three. We have mild, we have moderate, we have severe. You can have lots of scenarios. You can have intermediate steps. There can be a lot of like, well, what if this, what if that? There could be dozens and dozens of different steps. I simplified everything and just made it very straightforward and just used three. But scenarios are like well defined, like this could happen, or this could happen, or this other outcome could occur too. Okay. So what if we actually have so many outcomes we can't even really try to wrap our head around it? That's what Monte Carlo is. So if you have ever been to Monte Carlo, I never have, but I guess it's a big gambling place and in Europe, and I guess like it's going to the roulette wheel or the blackjack table or something like that. There's so many different potential outcomes. How do you analyze every single one and distill that and try to manage that and try to quantify that and try to understand that There could be 10,000 different outcomes. There could be 100,000. There could be millions of different outcomes if you sit at that roulette table for an hour, the ball's spinning around, the wheels spinning in the opposite direction, right? There could be so many different things. Like, how do you simulate that? That's what Monte Carlo is, right? So that's where the name came from. We're going to do many different combinations and then see what the outcome is, right? So over here, we had three outcomes. We just had three. So mild recession, moderate recession, severe recession. Now let's look at this potential outcome. And again, this is just a hypothetical. We don't know what's going to happen, but we're going to look at thousands and thousands and thousands of different outcomes and see where the bank is going to land. Where's your book of business? What's your outcome? What's your financials look like? How strong are you? Can you survive? Are you going to be acquired by a bigger enterprise, right? Are you going to just go down and go out of business, right? So the Monte Carlo simulation shows you all these potential outcomes and your total losses. The total losses on the x-axis in terms of millions of dollars, right? You can see on the screen right here, 1.3 million is the lesser, up to 2.1 million is the greater. The 95th percentile, this is like the probably the worst case scenario, and it could actually get worse. But 95th percentile is like, okay, it's going to get bad. And this is probably the worst case scenario. It could get worse than this, but it's probably unlikely. 95% of the time, even if we have a major recession and big pullback and everything is just blowing up all over the place, in this scenario, we can lose 1.974 million. Okay, so in this analysis, that's the worst case scenario. Basically, it could be a little bit more, but 95% of the time, if there is a recession, it's going to be less, right? So probably the midpoint would probably be around here. You can see it's kind of like normally distributed, kind of like a bell-shaped curve, right? It looks like a bell, almost bell-shaped curve, normal distribution. And the worst case scenario most likely would be 1.974 million of losses, but in the rare case, it could be a little bit more. We could lose 2.1 million of our book of business. Okay, so just that's it. That's the simulation analysis, Monte Carlo simulation, and the how to quantify the impact of an economic downturn on banking operations. So what do we do today? Look at balance sheet simulation, stress testing, right? If the economy tanks and goes down, like what's the worst case scenario analysis, and Monte Carlo simulation. That's what we achieved today. So hopefully that was informative and educational and somewhat inspirational. I try to make these a little bit inspirational and entertaining too. I don't know how entertaining my videos get, but I'm trying to get more. And that's it, guys. I'm going to wrap it up. Hopefully we hit the target today, and I will see you in the next video. Thank you for your time, and I'll see you soon. Goodbye.